Let me ask you a question that sounds simple, but almost always leads to the wrong conclusion. If you earn $100,000 while you're working and you earn $100,000 once you're retired, do you think the tax bill is still the same? Most people assume it is. Same income, same IRS, same rules. But here's what I see in real retirement plans. I've seen people retire, earn less income than they did during their careers, and end up paying more in taxes. And I've also seen retirees earning $100,000 who pay dramatically less tax than they ever did when they were working. That difference doesn't come from loopholes. It doesn't come from risky strategies, and it definitely doesn't come from guesswork. It comes from understanding one critical shift that happens in retirement. You stop earning income and you start designing income. And once you understand how retirement income is taxed, where it comes from, how it stacks, and how it shows up on your tax return, the difference between $100,000 working and $100,000 retired becomes very clear. So today, let's walk through why those two numbers, while identical on paper, can produce shockingly different outcomes. Hi, I'm Scott O'Connell with Tactical Investment Advisors. Today, I'm breaking down why $100,000 of income while working is taxed very differently than $100,000 of income in retirement, and why understanding this distinction can significantly change how you plan for retirement. If you find this helpful, feel free to like, comment, and subscribe. It helps more people find these educational videos. What $100,000 looks like while you're working. Let's start with the working years. When you earn $100,000 from a job, the tax treatment is straightforward and unforgiving. Wages equals 100% ordinary income. These wages are subject to federal income tax, subject to Social Security tax, subject to Medicare tax, often subject to state income tax. Every dollar is exposed. You don't control when the income shows up. You don't control how it's categorized. You don't control how it stacks with other income. You earn it, and it's taxed immediately. Payroll taxes alone take a noticeable bite before you even get to income taxes. Then federal taxes apply, and for many people, state taxes follow right behind it. There's very little planning flexibility here. Even if you're contributing to a 401k, the income is still earned first, then partially deferred. The tax exposure is still front-loaded. For many high-earning professionals, $100,000 of gross income can feel significantly smaller by the time it actually hits their checking account. Next, the fundamental shift that happens in retirement. Now let's look at what changes in retirement. One thing most people don't realize is that retirement income rarely comes from a single source. Instead, it's layered. You have Social Security, retirement account withdrawals, investment income, possibly pension income. And here's the key difference. Each layer follows different tax rules. Some income may be fully taxable, some may be partially taxable, some may not be taxable at all. This is where the comparison breaks down, because while working income is rigid and exposed, retirement income is selective and controllable, at least early on. This is why the same $100,000 can behave so differently. Next, Social Security changes the tax math immediately. Let's talk about Social Security, because this is often the first major shift in retirement taxation. Social Security is not taxed like wages. There are no payroll taxes, and it is never taxed at 100%. Social Security taxation depends on combined income. Up to 85% of it may be taxable. Some benefits may be tax-free. That means a retiree receiving $35,000 or $40,000 from Social Security may only have a portion of that amount included on their tax return. Compare that to wages, where 100% of the income is exposed from $1. This alone can dramatically lower taxable income, even before other planning strategies are involved. And importantly, Social Security taxation depends on what else is happening on your tax return, which means coordination matters. Next, retirement accounts add flexibility you never had while working. Let's talk about retirement accounts, such as traditional 401ks and IRAs. Yes, the withdrawals are taxable, but here's the difference. In retirement, you control the faucet. You get to decide when withdrawals start. You get to decide how much income you create. You can also decide whether income is smooth or uneven. This flexibility doesn't exist while you're working. While employed, income shows up whether you want it to or not. In retirement, withdrawals can be adjusted year by year. For example, a retiree might intentionally withdraw, say, $30,000 in one year, $45,000 the next, less in years when other income increases. That control allows income to be coordinated with Social Security, pensions, and investment income. And that coordination is where the tax difference begins to widen. Next, investment income isn't taxed like wages. Now let's layer in investment income. Investment income behaves very differently than earned income. Capital gains may receive preferential treatment from the tax perspective. Qualified dividends may be taxed at lower rates. No payroll taxes apply. So for retirees who have taxable brokerage accounts, the tax impact of investment income can be significantly lower than wage income. And importantly, investment income timing can often be controlled. You don't have to realize gains every year. You can choose when to sell. You can manage how gains stack with other income. Again, this is flexibility that doesn't simply exist while working. Next, a realistic $100,000 retirement income breakdown. Let's put this together. Imagine a retiree with the following income mix: $35,000 from Social Security, $40,000 from a 401k, $25,000 from investments. That's $100,000 of total income. But on the tax return, only part of Social Security may be taxable. The investment income may receive preferential treatment, and no payroll taxes apply. Compare that to $100,000 of wages, where 100% of it is taxed. Payroll taxes apply, and no timing flexibility exists. This is why retirees are often shocked when they see their first tax return after retiring. Same income, very different outcome. The Medicare factor most people miss. Taxes aren't the only cost that changes. Medicare premiums are income-based. Higher reported income can trigger IRMA. These are surcharges that increase Part B and Part D premiums based on income from prior years. This is where retirees can accidentally give back tax savings through healthcare costs. A poorly timed withdrawal or large one-year income spike can raise Medicare premiums for multiple years. This is another reason retirement income planning isn't about maximizing income, it's about managing exposure. Why some retirees pay less tax on $100,000 than workers ever did. This is the part that surprises most people. I've worked with retirees earning $100,000 who pay less tax than they did at $70,000 while working, stay in lower effective tax brackets, and avoid Medicare surcharges. Not because they're exploiting the system, but because retirement income allows for intentional design. Working income is automatic. Retirement income is strategic, and strategy changes outcomes. And next, why this changes how you should think about retirement. This difference changes how retirement should be planned. The goal isn't to replace your salary dollar for dollar. The goal is to replace your after-tax lifestyle. When people miss this, they often overestimate how much they need to save. They delay retirement unnecessarily, and they create avoidable tax pressure later. This is where working with a financial professional can make a meaningful difference, not by chasing returns, but by coordinating income. $100,000 is not just $100,000. What matters is where it comes from, how it's taxed, and how it fits into your overall plan. The shift from working income to retirement income changes the rules entirely. And understanding this shift is one of the most powerful steps you can take toward a confident retirement. If you're approaching retirement and want to make sure your plan is working for you, not against you, let's talk. Click the link in the description below to book a free consultation, and I'll walk you through your options.